Check the mic and make sure it sound right, boys. It sound right, boys.
Hi there. Good afternoon. I'm Perry Boring, the founder and president of the Chamber of Digital Commerce. We're a trade association headquartered in Washington, working on crypto, public policy impacting digital assets, and blockchain technology. So today we'll be talking about the macroeconomic drivers impacting the adoption of digital assets. We have an A-class team of speakers here. I'll have each of you just introduce yourselves, name, where you're from, and maybe just a quick overview of your firm's focus in the crypto space. Dan, we'll start with you.
Hi, hello everybody. Dan Tapiero, 10T Holdings, founder and CEO. We are a mid to late stage private equity firm that focuses exclusively and only on businesses in the digital asset ecosystem. And as far as I know, I think we're the only ones out there right now focusing just on the mid to late stage businesses. So we've put quite a bit of money to work in the first 6 months of the year and look forward to being involved in the space for the foreseeable.
Hi everyone, Bill Campbell. I'm a portfolio manager at DoubleLine Capital. DoubleLine is a $135 billion multi-asset management firm. I manage the global currency and global interest rate strategies. We like to think of ourselves as a forward-thinking macro firm. A lot of my research has been in the crypto space on CBDC adoption, and the DeFi wave and its implications, the macroeconomic implications across economies, both developed and emerging markets, and how it can both, how it's developing itself, but how it impacts the more traditional investments, and more specifically, how it could be a disruptor to macroeconomic models, currencies, and interest rates.
Amazing. Hey, everybody. Matt Hogan. I'm the Chief Investment Officer at Bitwise Asset Management. Bitwise is a crypto asset manager. We're best known for having created and today running the world's largest crypto index fund called the Bitwise 10 Crypto Index Fund. We also have the first and largest DeFi index fund. We manage about $1.5 billion in crypto assets, mostly for professional investors, hedge funds, institutions, and the advisor market.
Thanks, Matt. So let's just start kind of with the basics when we think about the macroeconomic trends impacting the adoption of digital assets, and just starting with money. Of course, Satoshi called Bitcoin a peer-to-peer electronic cash system. Just last weekend, the front page of the New York Times, an article on crypto that started with, Bitcoin is changing the definition of money. For thousands of years, civilizations have flocked to commodities like gold and silver as money. Today, money looks very different. What is your and I'll just open this up to either of you, kind of to you, what is money? How is it changing? How is Bitcoin and crypto impacting that?
Josh, you want me to
Go
start it off, please?
Well, I think maybe just taking a step back. Obviously, besides a unit of account, store of value, the legal tender, the unit of exchange in an economy, I think we need to think about money as a public versus a private asset, and a public versus a private good. For a long time, money has been thought of as a public good, and I think that the people in general have been willing to accept that premise. Then we hit the global financial crisis in 2008, and we saw the expansion of extraordinary policies by governments, and that caused a rethinking potentially of a lot of the policies that were being put in place that maybe are expanding the monetary base faster than people would necessarily like. So that moves us to the private money side. I know crypto is kind of deemed itself as like the new bastion of private money. But in the past, we've had private money. We've had bank issue private notes. And some of the issues that have come up with that is there's like preference of credit between different banks. Like if you have individual notes that are issued, there's going to be a credit preference between those. So there's going to be credit preference between different cryptocurrencies. We've also had like forms of private money throughout the credit card space. When we think about the transactions from Visa and MasterCard, even though that's thought of as credit, it's transactional. That is also has been a form of retail private money. So really, crypto is now kind of bridging that gap, I believe, between the purely public good that we initially thought money was to maybe more of the idea that private actors and now decentralized private actors can be a bigger player in the space and maybe can provide more institutional credibility than some of the governments. And not to jump the gun, but just to whet your appetite a little bit, I think especially in emerging markets where institutional strength and policies are fairly questionable, and where economies tend to not trust their sovereign currencies anyway and are dollarized, crypto has a very big window of opportunity to potentially disrupt and transform those economies.
Yeah, I agree with all of that. I mean, one thing, if you study the history of money, is that the history of money is never over. I think a lot of people sort of assumed that the history of money was over with the dollar being the king and all currencies being public goods, and crypto is one challenge of that. But really, it's evolved many times in the past. I mean, as you mentioned, this is not the first time.
Yeah. So
that the relationship of what money is to public and private sectors has changed.
yeah, no, that's a great point. And we're seeing significant tectonic shifts underway in what money is, how it's issued, how it's regulated, how we use it. And I think one of those big macroeconomic decisions was just over 50 years ago in 1971 when Nixon closed the gold window, which really launched us into this global fiat experiment. So just in either of your minds, how has that impacted kind of where we are today? And what do you see as the future of fiat, given how much has changed just in the past 50-year timeline?
I wanted to just say a word on the other question just for a second, and I'll link it into this one, which is that money, at least for me, has always been about return. And look, you've got negative 3, 4, 5% interest rates in the U.S. if you're using the CPI to deflate as the deflator. And I think that's caused a lot of people to think about, the nature of money that they never thought about it before. And one of the interesting things is that crypto really has been a retail-led phenomena. You have average Joes out there who have been long Bitcoin since 2011, 12, Ethereum from 15, and the institutions have been late. And they're still very late as far as I can see. I mean, it's still early for the general trend. And so I think the idea that there's return on your money or your cash or however you think about it in this new digital asset ecosystem is really what's driving it. Bitcoin as a store of value, Ethereum as a little bit different, but also something of lasting and permanent value. So I think that when you're looking for alternatives, there have to be alternatives. And I think this has now grown up as a real alternative.
Right.
So, sorry, I didn't answer your question. And I'm a gold guy too, so I didn't answer your question about the DPEG, the Nixon DPEG. I'm not sure what was the gist of what was the impact?
Right.
What
Yeah.
was
And when we went off the gold standard.
Yeah.
And how that's changed money and how that has impacted kind of the future of fiat.
Right. Well, I mean, it's allowed the authorities to inflate in an unlimited way. They're not pegged to anything. And so again, another reason for Bitcoin, which is infinite, there's a finite amount of it. And even the other cryptocurrencies, even like Ethereum, is not really, the supply doesn't really expand in the way that fiat has. And of course, post-COVID, you saw massive expansion in the balance sheets. And again, I think the average person out there is saying, hey, I'm losing purchasing power. I used to be able to buy this, and now I can't. And so there's no anchor. But that being said, you know, life is better today than it was for most people in 1971. So I don't want to say, okay, well, that decision 50 years ago was a disaster. I think we've had tremendous prosperity. So I think the answer to that's more nuanced.
Sure.
I want to build on that nuance, if it's okay, and then you
yeah.
can jump in. I think that's exactly right. Studying gold standards through history, they don't work that great in terms of launching economic growth either. The problem with fiat and inflationary fiat currencies is that eventually it ends poorly. And it gets worse in sort of an exponential fashion. And so, you know, from the fact we went off the gold standard in 1970 makes it necessary to have an alternative, which Bitcoin is emerging as an alternative. And it becomes more and more important and more important as a brake on the natural tendency for fiat systems to eventually hit a bad state of inflation. And I think it's just a time pattern. I think that's the nuance in it.
And if I can then further build on it, the inflation point and the debasement point are fantastic points. And depegging off the gold standard allowed the explosion of debt, allowed the explosion of credit. But what we've seen more recently, especially across developed markets, is the explosion of the monetary base, the explosion of all of the central bank activity has actually caused anemic growth. Like, I don't think anybody can argue that Japan has seen very strong growth, that Europe has seen very strong growth. And then after the bounce back from the recession, that we saw in March 2020, I think the U.S. glide path is coming back, lower. Now, people can say, look, the cause of that might be a big debt burden. But what I really think is happening is in the quantitative easing policies that have happened, what we've seen is taking of private assets out of the market, but really the explosion of institutional digital money, which is wholesale reserves. And banks ultimately have not been willing to lend that out or lend it out beyond large institutions. So I'm getting to the point that I think one of the structural drivers of low growth over time has been the headwind to productivity that large banks consolidating small regional banks and the unwillingness of them to lend to the SME sector is actually causing. Now, this is where DeFi and crypto can actually become a potentially game changer, not only in our economy but other economies in addressing this problem of productivity growth. Because if say through pass-through tokens, small and medium-sized enterprises are able to then access their customer base, get new sources of credit, get new sources of lending, and be able to spend that both on new business lines and potentially more hiring. I think that can both address the productivity problem, but it could also address the structural overhang that we have on the employment side as well. And I'll maybe stop there, but happy to dive in if you want.
Yeah, well, to build on that, Bill, I mean, you've highlighted that we're in a really just critical moment and key moment of government intervention. And what are some of those areas where you have government influence on the markets? What type of distortions is that making? And ultimately, what are the results of those?
Well, I think I touched on a few, but I can't overemphasize the importance of the central bank policy, not only on being a headwind to productivity growth, but also squeezing out returns. Like when we look across the risk asset spectrum, a lot of my credit colleagues are telling me that we're back to the historical lows that we saw in spreads prior to 2020. So, I think that central banks are unwilling to allow markets to clear. Crypto markets are completely unregulated, but I still think that they're in much of like the adoption phase. Like there is a lot of risk like embedded in them. They, to me, look much more like a VC market that has tremendous potential upside opportunity, but also a tremendous amount of volatility. But they do have I think that. Just sticking on the government intervention side, the other big aspect of it is the amount of fiscal policy and regulatory policy that's been put in place. We're seeing, continued expansion of, fiscal trying to actually push money to individuals. And, to get back to the inflation argument, this time around is different from, prior cycles after recessions. The, fiscal policy is actually pushing money to areas where we can see inflation. We're seeing higher commodity prices, we're seeing higher housing prices, we're seeing higher wages right now. So all of that, is real, on the inflationary side. And finally, just my last point on this, I think blockchain is unique in like the technological solution that it's providing. It provides, low latency, immediate settlement. It provides protection of individual privacy. And it's potentially the new wiring for the financial system. So for people who are thinking about, who are kind of pushing the whole DeFi blockchain revolution aside, I think they're missing that this could potentially be the new plumbing for the financial system that we all need to pay attention to.
Yeah, very key point. Just to kind of highlight the point on inflation, when I was a columnist for Forbes, I did a story penned. If you want to know the real rate of inflation, don't bother with the CPI. And I interviewed a statistician at the Bureau of Labor Statistics and talked about how they come up with their numbers. And it's very convoluted. Of course, they're tracking the price of goods, where, as someone who studied monetary policy in college, really it's the monetary base that really is, I think, the key thing you should be looking at in terms of inflation. So I think some of those numbers that are kind of put forward to measure inflation are a little funny. But I don't think anybody can argue that there's been this unbelievable expansion of the monetary base. We hear a lot about concerns of inflation. Even Senator Cynthia Lummis has very publicly said this is a huge concern for her and her constituents, and that's why she's bought, invested in Bitcoin, and even encouraging her constituents in the state of Wyoming to do so as well. So Matt, maybe I'll kind of focus on you, given what you guys do at Bitwise, really looking at this as an advisor, a financial advisor. Bitcoin has really kind of proved itself to be a non-correlated asset. The Federal Reserve Bank of St. Louis published a report in 2018 that says Bitcoin has the potential to emerge as its own asset class to be used for diversification purposes in portfolios. And I think that speaks a lot to your thesis at Bitwise. However, there's been a bit of hesitancy with financial advisors advising people to use Bitcoin as a diversification tool. Can you speak to how you guys are thinking about that and kind of how you see that and kind of where we're at today from a fiduciary oversight perspective?
Sure. If you didn't know it was called Bitcoin or crypto and you put into a portfolio optimizer, you would definitely want 1 to 5% of your portfolio to be allocated to it. The reason is, over any meaningful period, if you put crypto into a portfolio and you rebalance, as advisors do, it contributes to your absolute and risk-adjusted returns. We have a white paper on bitwiseinvestments.com. I mean this literally. Every 3-year period in history, including periods with 80+% drawdowns, if you put it into a portfolio, it increases your absolute and risk-adjusted returns. When we talk to advisors about it, there's really two key things that matter to them. The first thing that they have to get over is that it's not going to zero. The reason it's important to get over the fact that it's not going to zero is that if you want to put it in a portfolio and rebalance it, you have to assume it's not going to zero in order to harvest the volatility, or you can make a small allocation. The other piece is just to appropriately size your allocation. As long as you keep your crypto allocation at a reasonable level, it doesn't create mass drawdowns in your portfolio. So we've seen enormous growth from the advisor market. There's enormous interest from the advisor market. I'll end with one more stat on that interest. In January, we wrote the CFA Institute's first ever guide to Bitcoin, blockchain, and crypto. I believe it's their most downloaded research report ever. just as a sign of how much interest there is. So I think that's the next big market in crypto. It's the advisor space.
Yeah.
Coming soon.
We represent about 30 private equity funds at the Chamber, so we've gotten the opportunity to see how different fund managers are evaluating crypto. And really the general principle across the board is if you introduce Bitcoin into your typical portfolio, 1 to 5%, you see volatility go down and performance go up. So I've heard a number of people who had said once that is more widely understood, it will be seen as almost irresponsible to not recommend for clients to invest a percentage of their portfolio into Bitcoin for that diversification piece. Further, in March of this year, the chairman of the Fed, Jerome Powell, in his testimony to Congress, he said that Bitcoin is more of a substitute for gold than the dollar. So just to kind of expand on this concept, would love to get, Dan or Bill, your thoughts on, since the Fed owns gold and other central banks around the world own gold, what are your thoughts on the Fed and central banks substituting gold for Bitcoin?
Well, I don't know if they're ready to substitute it. Yeah, I think he was really talking more theoretically, that the principles behind Bitcoin as hard money are similar to the principles behind gold as hard money. People don't generally think of the dollar really, I mean, as hard money. It's used to transact, and it's the, the currency of the world, and it's super liquid, and it's not physical. So I think he was thinking about it in those terms, but I think that's very right, that store of value, Bitcoin is store of value as a high form of collateral. I think that's absolutely right. There are other cryptocurrencies potentially that you might, use for other purposes, but in terms of that pristine collateral, and again, it's all laid out in Satoshi's white paper. I do think that, and I think he's acknowledging this too, that it really is an invention. Bitcoin is an invention, and I always say it's an invention akin to the invention of the combustion engine or the discovery of electricity. And it's just that paper, people don't, I think, understand, solved a problem, the Byzantine generals problem, that had been unsolved for hundreds of years, and the problem of distributed trust. And so that aspect of Bitcoin as a solid, sort of secure, backed by the proof of work algorithm, I think is absolutely right, but not necessarily a replacement for the dollar.
We'll come back to that thought.
Yeah.
Bill, I want to focus on central bank digital currencies for a moment. So also, I mean, we've all seen the grayscale drop gold commercials, and kind of how, just this past month, El Salvador adopted Bitcoin as legal tender. So kind of looking at it from the central bank perspective, there's now, according to the Bank for International Settlements, over 80% of central banks around the world are already experimenting with CBDCs. So how do you see things like Bitcoin, ETH, other cryptocurrencies living in a CBDC world? Are these a threat? Are these a complement? Will they be interoperable? What does this look like fast forward 10, 20 years from now?
It's a great question, and I think in my mind we need to start segmenting different parts of the market out to try to get a framework for understanding and thinking about it. I think that central bank activities, the way that they really control markets and economies are through controlling the monetary base, setting interest rates, and controlling credit. And DeFi in general and blockchain technology is actually disrupting each one of those. So for the monetary base, obviously you're having new cryptocurrencies come out that are being accepted as legal tender in El Salvador, for example. Interest rates are obviously manipulated across the globe, and you're having new interest rate markets via staking and Then when we think of credit creation, I do think there's a lot of, there is a lot of potential for, credit creation in the crypto and blockchain network. In emerging markets, you're seeing about, especially across Latin America, when we think Peru, Colombia, even Mexico, about half of the population is unbanked. So, crypto is actually, you see a lot of DeFi protocols being picked up fairly aggressively because it's permissionless, and you get, a lot of, the debit card style, transactions, that come with like that, I would call it, banking 1.0. But you can imagine that there's going to be a lot more banking services that are going to be provided across the globe, across these different networks. So I think that central banks are looking carefully at I don't think they want to stifle this growth, but they also don't want to lose control of the credit-making mechanism in that. As far as the currency itself, when we think of CBDCs, I think you're just thinking of this is true retail digital money. And right now we have that in the form of stable coins. And we look at digital transactions. I'm sure, Dan, you've seen this, 85% of one side of all transactions are via a stable coin, whether it's USDC, USDT, or the like. So once you introduce the digital dollar, and you don't have to have the issue of trying to understand the collateral backing of the stable coin. I know there's been some questions about Tether. There's a big debate, but would the CBDC or the digital dollar become the preferred stable coin in this ecosystem as long as it didn't do what China did and set a centralized blockchain that removes your privacy? If it truly is in the form of a stable coin that's settlable on ETH, that's settlable on any other the blockchain networks, potentially it becomes the superior solution. And then the final point is, I think that the U.S. dollar's reserve currency status is threatened by the DeFi revolution. And just to quickly expand on that, we're seeing I think it's more the digital payment systems and the cross-border payment systems that provide the threat more than the CBDC itself. So the BIS through Project Dunbar is looking at in Asia between Australia, Singapore, Malaysia, and I think a couple of other banks trying to integrate the payment systems via blockchain. In that region. And by the way, there's a new trade agreement, RCEP, that is looking at the regional cooperation of trade in that region. So as countries begin to develop this technology, as you have new regional trading agreements, isn't it logical that 60% of reserves being denominated in US dollars might not be necessary? Don't you think that you as a country would prefer to settle the majority of your trade on a bilateral basis with your balance of payments trading partners? And I think that removing the dollar as kind of that fundamental denomination for trade, fundamental denomination for commodities, commodity settlement, runs the risk in the long term of being a potential dethroning of the dollar's U.S. reserve currency status.
Yeah, I mean, I'm not so sure about that. I mean, I just think that, look, 60% or whatever the number is too big. And, after the war, it made sense. All the other economies were at zero, and they were flattened. And for many years, I think people just got, used to having the dollar in the center. But if you just look at GDP, the U.S. is, I think, what, 25% of world GDP?
It's actually come down. It's closer to 20, and
right.
China's gone up to 20.
Right, so, I mean...
And Europe's about 22.
It's been inconsistent for years that, that the U.S., that the dollar was overweight in everyone's portfolio. So I think it's just a slow transition. I mean, as a macro guy for 25 years in the hedge fund business, I always, I always remember the quip that, macro always takes longer than you think it will. I was sitting there with investments, and you think it's going to be 3 months, and it's 3 years. And I think this is a perfect case, of this. I don't think the dollar's going away. I don't think America's going away. I think, and this might segue into the next question you want to ask, but I think that if we start to make some very poor decisions on the regulatory front here vis-a-vis the digital asset ecosystem and blockchain technology, I think that is dangerous for us because the U.S. is already behind, I think, the rest of the world in adoption and understanding. 90% of total world cryptocurrency volume is outside the US. So there is a chance here that the world moves forward without us at the lead. And that sort of worries me a lot more
Yeah, is that
Dan,
the real?
okay, I
Right.
stole a little bit your thunder there because I know you wanted
no.
to talk about
No,
that, but
I mean, especially in my role as an industry advocate working with public policymakers, very careful not to kind of pin the crypto space against the status of the US dollar as the world reserve currency. In fact, I don't think it's a helpful argument to say they're competitors, especially with something like Bitcoin that's really operating as a store of value, akin to a digital gold. That serves a very different function than payments. And I think both can coexist and you have kind of US dollars and stable coins as your transactional layer and Bitcoin as that store of value. Dan, I did want to come back to your thought on kind of the combustion engine. And you have said Bitcoin and blockchain, they're a historic invention akin to the invention of the combustion engine,
Right.
and will have a similar transformative impact on our world. So I think kind of what you're getting to is that this isn't just about money. There's a revolution beyond just money in the crypto and blockchain technology. So one of the things that I really challenge kind of our members to help articulate better is how this technology is going to have an impact on the daily lives of normal people, not necessarily just like your hedge fund managers and your investors, but the citizenry. How is this technology going to impact the average person for good?
yeah, I'll just say one quick thing and then I'll let the guys answer as well. But I mean, I think it's a revolution in trust. And so it's a permanent record. I've read, and other people have also called it a truth machine.
The cover of The Economist a couple
Right,
years ago.
that's right, and there's a book also. But I think that's what the real, if you want to be abstract, think about all of the things in the course of human interaction that rely on trust. And a lot of times there isn't that trust there. And so, I mean, I think that's the really big revolution. I mean, I don't know if you guys.
I completely agree. I think the other interesting aspect of blockchain is being able to protect privacy and anonymity while still having publicly available a vast amount of publicly available information.
Yeah.
So far, we've been lagging China as far as AI development and and network effects because of the concerns about privacy. So blockchain, moving outside of finance, has the potential to, allow network effects, the Internet of Things, like take off medical records. There are a lot of potential use cases that, can come out of this technology. And I think that all comes from your point that the key element is trust and keeping privacy.
Well, and that this also is, a massive decentralized network that from a security perspective is really bulletproof. I mean, it could end up becoming, and I'm not saying which network specifically, could be the Bitcoin network, could be another one, ends up becoming the value layer, for the entire internet. And so, I don't want to bring it back to this again, but I worry just now about the U.S. sort of not being innovative enough and
100%.
not seeing these bigger picture concepts.
Yeah, I'll agree with that, and then I want to talk big picture as well, because that's fun. I think we're already blowing it from a regulatory perspective. To put one very narrow, maybe controversial dot on it, if I agree with Dan that the US dollar and the US position is in a slow fade as a relationship to its GDP, we had this sterling opportunity once in a lifetime to delay that and extend it if we had embraced Libra as its dollar-backed stablecoin.
Oh, yeah.
What better way to get the entire world to
Yeah.
use dollars in every transaction and to put a huge amount of money in a dollar-backed asset? And we just turned up our nose at it. I mean, it was literally a once-in-a-lifetime opportunity, and I think we totally blew it, and we can't get that back. What will your daily life look like is something that crypto struggles with. And the reason it struggles, I think, is that the primitives that crypto introduces are so large. Dan, you mentioned trust. You can talk about digital property rights. You can talk about instantaneous settlement. And the landscape of possibilities that are created by these primitives is so massive that the crypto industry typically falls back on small examples, like improving the remittance system, or lowering fees, or allowing people to make their financial assets more usable. And those are all true, and those are all the baby steps. But just like in the early 90s, predicting all the things that the internet would do was very, very difficult. It's often good to dwell on one or many of those primitives and just spend a week thinking about what does digital property rights mean 20 years from now. It's easy to look at $3 million digital JPEGs of rocks and laugh at NFTs, but if you stop thinking of it like that and start thinking of it as the first instantiation of digital property rights and allow your mind to wander for a little bit of time, thinking about what that means in 10 years is huge. So it's hard to make them very specific, it's hard to predict the future, but the primitives in crypto are so powerful and so sort of world-changing, it's very exciting to think out 5, 10 years.
Yeah, but you know, I would say one thing is that older people, they say, well, what do I need digital property rights for? Versus the sort of under 30 crowd that are gamers, and it's very natural for them to think about digital property rights because a lot of their assets are already digital, right? And so, go ahead, what were you gonna?
No, I had this great conversation with a reporter, and he was like, I don't understand why someone would spend like $5,000 on like a sword, and it's not even a real sword, it's digital. I'm like, it's got so much more utility to people than a physical sword. When's the last time you used a physical sword? It's been a long time. But like these kids are using digital swords all the time to create status, to win rewards.
Yeah, it's also because they're spending 8 hours a day online, and that's something, you know, that none of us older guys can really, I mean, we're on the phones and everything, but literally, I think it's 8 hours a day is the average, you know, usage, and these gamers are on even more. And so they are going to the, you know, metaverse, to these virtual spaces to actually meet people and hang out and live in, you know, digital land and all of this stuff. People are living their actual lives. Yeah. I mean, we're not, I mean, but it's more and more that way. And so for them, digital property rights, I mean, there's not even a jump, right?
Exactly, yeah, that's exactly right. And it is hard for older people to get their head around that, I agree.
But the digital property rights it's such a huge concept, and I think we need to figure out on regulation or litigation, you know, what exactly is protected, you know, when we start writing, you know, individual code. But when that's figured out, it has the ability to provide, you know, a lot more liquidity to like venture capital space, private equity space, like a lot of spaces that, you know, historically, you know, maybe haven't been accessed as widely. But also, we need to think about, now we have these new entities that are digital autonomous organizations that are made up of a bunch of individuals that kind of vote on, like, you know, what the platform should do. So what rights, you know, are